Hello and welcome to the Monday Futures Market Outlook for August 9th, 2010. This is Patrick Ceresna. eMiniSource.com is excited to announce the launch of its new trading room. If you have not had an opportunity to try out the eMiniSource trading room yet, a 5-day complimentary membership is available on the site. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on there, does a very good job to depict the bull and bear market cycles the market have gone through. Many months ago, we crossed bullishly above that 80-week moving average, asking the question, are we at the beginning of a new multi-year bull market? At this juncture, we still remain with our bearish thesis on the market, but under these circumstances, this entire consolidation into the summer and subsequently any weakness into the September-October month cycles will give us the information as to whether or not this really is a bull market. If that's the case, we expect even over the next several months, all sell attempts to be contained somewhere within the 1,000 to 950 area, and subsequently the market would use that base from which to launch its next major bullish move into the year end. But the reason we won't change our thesis is at this moment we cannot rule out the possibility that this entire rally we've had since the March 2009 low was nothing but a rising wedge formation that is a midpoint for another leg down in the market. Now, even though we don't favor this scenario, at this point we cannot technically rule it out, and therefore we're going to remain with our thesis until the market proves otherwise. When we take a closer look at that S&P 500 using that E-mini futures contract, we were looking for a market rally that would have pushed right up into this 1125, 1150 area. By every regards, by middle of last week, we had completed that move. Friday's sell-off could have been a legitimate reversal on the downside based on that jobs number, but the bulls dug in and reversed that on the upside. There is no technical damage yet done to this trend, so we cannot rule out the fact that we'll have a couple more thrusts higher up towards the 1150 area on the upside. But if, let's say, the Fed minutes on Tuesday end up being a catalyst or some other event like that, then we could see this market turn and reverse and put in some legitimate highs up in this zone. If we do end up seeing a significant market reversal over the next week or two off of this area, then we expect the sell-off to continue through late August, September, and maybe even to October. That would have us retesting the previous lows of the summer around the July level in the 1,000. But we could also theoretically see lows even as low as like the 960 level on the downside if that was to happen. Before we start worrying about downside targets, we first need to see a short-term high come in and a reversal that actually sticks. So let's watch if we get that this week. To review our key points, our thesis since January 2008 has been that we're in a secular bear market. We will not change this thesis until we see the extent of the selling we see in the current cycle that we're in. So we still believe that there's a legitimate chance for market weakness into September, October. But overall, if the bulls do a very good job defending or containing all the selling in that 1,000 level on the S&P, then that would actually have a pretty bullish implication for a reversal for a year-end rally. Support held at the 1080 to 1090 level a couple weeks ago. We were looking for that upside market to work its way back up to this 1125, 1150. More or less, we are up there, but we can't rule out a little more strength. We continue to be skeptical about the sustainability of any rally into the fall, and it's very important for investors to stay conservative in your investment portfolios. My whole reasoning here is that you're probably better off being late to the party and know that there is not another wave of selling than to be rushing in right here at the worst risk-reward moment to go long and then just get caught in another pullback. So at this stage, I would be recommending investors stay conservative. Next here, I want to take a look at the NASDAQ 100 using the E-mini futures contracts. We also had our upside measured move somewhere up in this 1900 level. We could see rallies that potentially can go even as high as the 1980 level. But the significant overhead resistance we're looking for is around that 1930 to 1950 area on the upside. Nonetheless, we are looking for some short-term strength that could get up in there, but maybe even as early as the Fed minutes on Tuesday, we will be looking for reversal patterns off of these higher areas. Next here, I'm going to take a look at the U.S. dollar index futures. The jobs number on Friday came in forced a key retest into the 80 to 80.5 area on the downside, found support there and reversed slightly on the upside. We will be looking to see whether or not the market can bounce off this level. This is a key level where a short-term low could very well come in, and we'll be looking for some sort of a Fibonacci retracement rally to come off this zone. Now, that doesn't mean we can't have a one-day drop that test that low is, let's say, that around the 79.75 level on the downside with a quick reversal back up. But in the end, we think that this is a place where we're going to get a market bounce of some sort of significance. Next year, I want to take a look at gold futures, and more or less we continue to see another round of strength in the gold as it approaches that critical 1210 area on the upside. The 1210 to 1225 area marked by the blue box is more or less a key retracement area that we're watching. If in fact gold is going to have two distinct sell cycles in the zigzag pattern lower, this is the level from which gold reversed back downwards, and so we're going to be watching very carefully whether we get the reversal here on gold or not. If gold is destined to actually go higher from this level and not have another retest, we should see at some stage here gold have the strength to break above this 1220, 1225 area and make a legitimate push toward previous highs. So we're going to get some critical information shortly. Next here, when we take a look at oil futures using the crude oil mini contract, we had a bullish breakout the other week above the 80 level that followed through up to the 82 level on the upside, where there was a number of highs and lows put in during the March-April cycle. This is now a completed measured move higher on the upside, and it would be very logical for oil to put in a high here. But I understand that this is a direct play on the dollar bounce. If we have a dollar index that bounces off this 80 level and creates a strong retracement rally, then crude oil will sell off this level. In the same regards, if we never do get a dollar rally, then crude oil can make a break and actually attempt the 87, 88 level on the upside where it made its previous highs. So we're going to be watching very carefully as to whether or not this reverses with the dollar. Finally, I want to take a look at the 10-year Treasury notes, and whether we're looking at the 10-year or the 30-year, we're seeing distinct trends higher, continuing to push the yields lower, supporting deflationary outlooks on the broader markets. At this juncture, we are now fully on the upside in our target zone. We are looking for a move that potentially could go as high as 126. So we don't want to cut off the upside here, but understand that at some stage Treasury bonds should take a break, or at least go through a profit-taking cycle off of some sort of levels up in here. So we'll be going with the momentum on the hourly chart, seeing whether we can catch a little bit more on the upside, and then we'll be watching for at least a short-term swing lower or a consolidation pattern to begin up here. That was your Monday Futures Market Outlook. Thank you for joining me.